Hi, this is Alessio. Hope you're well. In this video, I want to take a look at this important chart here on the S&P, on the stock markets, and what it's potentially telling us here at the moment. In fact, as you can see here, the S&P has just managed to break below that trend line support. You can see that yellow line. That's an important trend line support based on closing prices. It's just broken below that level. And as a matter of fact, we're also below this level, the 4,400 level here. I'll explain that in a few minutes. But here's the more important part here I want to explain. By the way, notice today, we're also forming a gap on the chart. There's an open chart gap now, gap down, which I'm sure, as you know, is a sign of uncertainty. It's a sign of fear in the market when you see a gap down. And these gap downs usually tend to get filled in the weeks and months ahead. Now, here's the bottom line. The bottom line is this, that you may remember back in July, I put out a video and I explained the importance of what was happening here in the market. Here's the video clip. Let me play it for you.
When it has climbed this high, in other words, whenever hedge fund exposure has been this high, the S&P ended up giving any further gains back. As you can see from this chart, in fact, hedge fund exposure is very close to being 40% when it was almost flat just about a month ago. Usually this is a contrary indication that whenever hedge funds get so bullish, whenever they enter the stock market with leverage like they're doing right now, that's usually a contrary indication. It's a major warning to the stock market that this so-called smart money, again, it's the dumb money really, when these guys are entering the market with leverage, usually very soon afterwards, the markets start to decline and go down. So in other words, in the short term, potentially in the next few weeks and months, it's likely the markets could experience volatility and potentially go down. And usually when something like this happens, the markets usually experience weakness and they experience a decline. The short-term expectation for the markets within the next few weeks and months is not very good. So guys, this means the action of the hedge funds is a likely warning, a major warning to the stock markets.
All right, guys, as you heard there, that was the key point in that video. Essentially what was happening was back in July, because all the hedge funds out there, the hedge funds had missed out on the gains in the stock market since the beginning of this year. What they tried to do is try to make up for that by getting into the stock market here, as you can see here. As you can see, so we had data, again, as we explained in that video. Essentially, these hedge funds are piling into the stock market in droves right about here. Okay, and it's always a bad sign when hedge funds are getting into the market for reasons we already explained. But as you can see, the gains made over the last couple of months have now been eviscerated. They've been evaporated in just, as you can see here, just a few days and weeks. So as you can see here, all the gains here on the way up have now been evaporated, as you can see, by this decline in the major markets. Again, we had advanced warning of this some months ago. Now, here's something else. You may remember this interview I did with Manuel, the Dow Theory, and essentially we talked about this divergence between the transportation index and the S&P. So we had divergences between the S&P and the Dow, and divergences between the S&P and the transportation index. And guys, here's the thing. As I explained in that interview in this video, here's what we said.
Normally, the transports tends to lead the industrials.
You make a very good point. The stock markets have been making higher highs. The Dow transportation is diverging, making lower highs. You're saying this is a warning. It's a warning, right?
It's a big warning. Ria, the famous Dow theorist, he wrote about that. If I say something, I want it to be backed by numbers.
All right, guys, welcome back. So as you heard Manuel say there, it's never a good sign when you see this divergence and non-confirmation. So essentially what was happening was that the transportation index was not confirming what the S&P was doing. In fact, let's take a look here at the transportation index, as you can see here. So notice the transportation index made a top back in the month of May. It's been declining. In fact, it's been on the way down pretty much ever since. So as you can see, this is a divergence. It's a non-confirmation of the rally in the major stock markets. And by the way, guys, let me just say this. When I put out that video about the Dow Theory and the transportation index, I noticed a couple of comments from some people who were trying to make excuses for why the transportation index was falling based on news and fundamentals, schmundamentals, all that nonsense. They were trying to say, oh yeah, it doesn't matter if the transportation index is falling. It's because of COVID and transit issues. There's nothing to worry about. Guys, as you know, it's always a big mistake to try to explain what's happening on the chart based on news events and fundamentals, schmundamentals, all that mumbo jumbo. And if you want to know why it's a big mistake to do that, read the book by Nassim Taleb. It's called Fooled by Randomness. In that book, Nassim Taleb explains what's called the availability bias. The availability bias is simply the human tendency, the human bias, that we think the data or reason for something is available to us. The fact is it's not. Most of the time, the real reason or explanation for something is not available to us. We don't have that data until several months or years later. So that's why it's a bad idea to try and explain something in the market based on current news events or purely on fundamentals. In fact, here's what Robert Prechter says in this interview.
Most people look at news and events and so-called fundamentals to decide where markets are going. But I think people using the fundamentals are mostly lost because the fundamentals lag what the market is actually doing.
All right, guys, Robert Prechter is absolutely right. We have to pay attention to the charts and the technicals, because if we just ignore the technicals and looked purely at fundamentals, for example, people who ignored the non-confirmation signal, the divergence signal, they had a major disadvantage. Okay, guys, so that's why it's always a good idea to look at what's happening on the charts and trust the technicals, what they're telling us. Okay, let me just say this. As far as the chart here is concerned, yeah, the S&P has now broken below 4,400. The reason why that matters is 4,400 is a 3% drop from the highs, the closing highs. Okay, guys? So really from here, the closing highs back in September to here is a 3% drop or more on the S&P. Please excuse my handwriting here. Okay, guys? And according to Dow Theory, the Dow Theory says that a 3% or more drop on the S&P counts as a secondary reaction based on the Dow Theory. So, guys, I think that as long as the S&P is still below 4,400 today or this week, then we have what's called a secondary reaction based on the Dow Theory now on the S&P and also on the major stock markets, on the Dow and also the Dow Transportation Index. And in case you're wondering, a secondary reaction is just the first step of the Dow Theory system. Now, again, all essentially what this means, guys, is that we've now broken key support levels, broken the trend line, and the 4,400 support level. So I think the odds are increasing, as I've been saying now for some weeks, that we're heading towards a major multi-week and a multi-month correction now on the stock markets. And I think that's where we're heading now in the major markets. By the way, take a look at this as well. It's the VIX, the volatility index. We can see volatility has just massively spiked here today. And we need to remember when volatility rises, risk also increases as well, because of the fact that usually when volatility rises, strong declines in the stock market can be followed usually by strong bounces as well. And of course, the big question is, how much of an impact could this have on Bitcoin as well? It's going to be quite interesting. We'll have to find out. Thanks very much indeed. Bye for now.